We focus now on investing in real estate. Our next guest oversees an $18 billion plus portfolio of real estate. Joe Rodriguez is here. Nice to have him in person. He is the head of the global real estate securities for Invesco. Joe, glad to have you here and in town. Welcome back to the Big Apple. I know you've been traveling around the country, so I'm going to ask you what you've noticed as you go. But in the meantime, what is the overall tone like right now for investing in real estate? Are there more opportunities now than there were, say, a year ago?
Well, I think the general tone is positive. We're starting to get good economic numbers, fits and starts. You know, every now and then we get a number that doesn't look so good. But generally speaking, we're on a positive recovery here in the United States, and so little new construction going on that any growth is going to be positive.
Most people say there's still maybe another year or two where we stay at this plateau. Does that sound timing-wise accurate, more or less, to you?
I think for the general market, but there are pockets of strength. I mean, I would point to apartments as being a very strong part of the market right now. I would point to hotels doing very, very well. I would point to some of the industrial and warehouse companies recording very good gains in their occupancies. So there's some pockets of strength.
The apartments don't surprise me in a sense, because maybe people who had trouble with their credit rating or who don't want the responsibility of a mortgage for whatever reason, I can see apartments holding up pretty well. But hotels, does that mean more and more people are traveling?
That's exactly right. And we're seeing good business travel. Rates are going up. I mean, go to some of the hotels here in New York, your eyes kind of pop
yes,
with some of the rates. We're going to start seeing more and more of that creep in across the country. But could I go back to apartments for a little bit, Deirdre? I think the points that you hit are absolutely right on. The other thing that I would mention here is that, you know, we're still about 66% home ownership rate. If we go back down to 64, that means people are still not buying homes.
And they need somewhere to live.
And they need somewhere to live. I think we have several years running here on the apartment strength. Some analysts we talked to, I think, are being a little too conservative in their numbers. I think we have quite a bit of room to run here.
When you say pockets of strength, is it geographical, or is it a price range, or is it both?
Well, it's kind of both. We talked about the property types, apartments, hotels, and industrial. But if you go geographically, the West Coast is doing particularly well. I just came back from the Bay Area, and you look at some of the office rents increasing in general in the overall Bay Area market from 15 to 35%. In the South of Market,
that's a big jump.
In 1 year. In South of Market, those rates of increase are closer to 35 to 40%. We've seen vacancy rates come down considerably, and I think this has been quite a buoyant recovery.
Well, we've been speaking with more and more angel investors and more venture capitalists, so we know there's business activity, but we just didn't know if people were ready to go into an official office. There's some hotels here that have lobbies, and that's where people work, but it seems like they're actually interested in getting some office space as well.
Absolutely. The creative space, particularly in the Bay Area, is renting at a premium to the traditional office space. You have to pay about $5 more to get the creative space. So the gaming companies, the media companies, folks like Macy's.com, Zynga, Salesforce, they're very active in these markets and are really taking up space. You know, so it's not only the VC money, but these people, unlike the dot-com days of 1999 and 2000, have real business platforms, real revenues, and they're hiring real people.
So, Joe, if the Bay Area is a bright spot in the U.S., and I know most of your portfolio is in the U.S., something like around 60%, give or take.
That's right. If
you had to pick one other spot in the world that is attractive for an investor right now, what do you like?
Well, I think a kind of a distant second, although it's a very good place, is Midtown Manhattan. Vacancy rates here.
You don't consider Manhattan part of the U.S. I'm not even going to be offended. I'm just teasing. Go ahead.
It's about 8% vacancy here, and rents increased about 9%. But if I had to look outside the U.S., one of my favorite companies that we own, CFS Retail Trust in Australia. This is a company that owns 3 of the top 5 regional malls in Australia. Very, very productive. This company pays about a 6.9% dividend yield. And last time I checked, Australia is one of those economies that's doing relatively well.
Yeah.
And so I think we're going to get some growth out of that as well. So great yield as well as growth. So the objective of our fund is to not only provide a good yield, which we're mid-4s right now, but really to do a very good total return with lower risk profile than, say, some of our competitors. And so far, we've been able to do that.
Joe, we thank you for stopping by. Joe Rodriguez joining us here in person. He is the head of the Global Real Estate Securities Division at Invesco, $18 billion plus under management.